Hello everyone and welcome back to another video. In today's video, we're going to be talking about Microsoft, Meta, and Amazon's earnings reports. They all came out this week and it's been pretty dramatic. Microsoft and Meta had incredible reports and then Amazon's was decent, but definitely had some red flags in there that I want to bring up. And to be fully transparent, I am an Amazon shareholder, but I try to be as objective as I possibly can be and really be critical of these companies that I own. So we're going to be diving into these three earnings reports, and then if we have time, I will discuss some more like PayPal and FICO, but we're going to see how much time we have. And if I don't get to those ones, then I will be making a follow-up video discussing more earnings reports as we have time. So with that being said, let's discuss Microsoft first. And Microsoft stock was making brand new all-time highs after their earnings report. The stock has pulled back a little bit since the earnings report, but the market did respond pretty well to Microsoft's earnings. And the stock is now up roughly 50% from its April lows. So it's seen a very strong rebound, and we can clearly see that the stock is making fresh all-time highs. So let's dive in to the earnings report now, and I took screenshots of all of the things that I think investors need to know. Microsoft's revenue for the second quarter, which is actually their fiscal fourth quarter, was $76.4 billion, an increase of 18%. Operating income was $34.3 billion, up 23%. Net income was $27.2 billion, up 24%, and diluted earnings per share was $3.65, up 24%. Then Satya Nadella says, "Cloud and AI is the driving force of business transformation across every industry and sector. Azure surpassed $75 billion in revenue, up 34%, driven by growth across all workloads." We closed out the fiscal year with a strong quarter, highlighted by Microsoft Cloud revenue reaching $46.7 billion, up 27%. So Microsoft had an outstanding report. These numbers are truly insane. Think about this. Azure is producing $75 billion in annual revenue now, and its revenue was up 34% year over year. This is like small cap startup growth rates on a company that is producing $75 billion in annual revenue. What's also interesting is Azure's revenue growth rates are accelerating. So not only is this business posting extremely high growth rates on such a large base, but its growth rates are also accelerating, which is absolutely insane. It is wild to me that these cloud businesses have such large revenue bases, but can post numbers like this. I don't think this has ever been seen before in the world. This is absolutely crazy. So yeah, Microsoft killed it. The stock deserves to be at all-time highs in my opinion, and it's no wonder why the stock is up after this report. Now moving on to the next screenshot, this one shows us all of Microsoft's different business segments. And look at the growth rates here. Microsoft Cloud up 27%. Microsoft 365 commercial products and cloud services 16%. Microsoft 365 Cloud 18%. Microsoft Consumer Cloud 20%, LinkedIn 9%, Dynamic Products and Cloud Services 18%, Dynamics 365 23%, Server Products and Cloud Services 27%, Azure and other cloud services 39%, Windows and OEM and devices 3%, Xbox content and services 13%, search and news advertising excluding traffic acquisition costs 21%. So every single business segment for Microsoft is growing, and many of them are growing by double digits. This is a freaking wild report. I could not even believe this when I was going through it. Now let's move over to the cash flow statement. And here we can see that operating cash flows came in at $42.6 billion versus $37 billion last year, which is up roughly 14% year over year. For the full year, Microsoft generated $136.2 billion in operating cash flows, which was up roughly 14%. So on an operating cash flow basis, they're not growing as much as net income or revenue. This is still great growth, but personally, I am valuing these businesses off of operating cash flows now, and the operating cash flow growth rates were below net income, operating income, and revenue. So now let's take a look at how Microsoft spent this $136 billion in operating cash flows. And here we can see that they bought back $18.4 billion throughout their fiscal year 2025. Now, what's interesting about Microsoft's buybacks is they're clearly not plowing a lot of money into buying back stock right now. I mean, think about it. They produced $136 billion in operating cash flows, but only $18 billion went to buybacks. That's roughly 15% of the operating cash flows. This compares to Google, where they're plowing a lot of money into buybacks, Apple, which is plowing basically all free cash flow into buybacks. Meta's also spending more than they produce in free cash flow on buybacks, as we're going to see. But Microsoft really isn't spending that much on buybacks anymore. And if we take a look at their cash payments of stock dividends, they spent $24 billion on dividends. So they spent about a net of $42 billion on buybacks and dividends, and that's how much they returned to shareholders in 2025. Then we can see their additions to property, plant, and equipment, which is their capital expenditures, were about $64.5 billion versus $44.5 billion last year, and their capex did grow by about 40%. So year over year, Microsoft is spending a lot more money on capex this year. Moving on, this is in regards to the company's outlook. And here we can see that Microsoft expects another year of double-digit revenue growth and operating income growth. Operating margins are expected to be relatively unchanged year over year. For the first quarter of 2026, the company is expecting revenues of $76.4 billion. Revenue for Intelligent Cloud is projected to be between $30 and $30.4 billion, a growth rate of 25 to 26%, and Azure revenue growth is expected to be approximately 37% higher in constant currency. So Microsoft is expecting their net revenue to grow by about 16% in the next quarter, so their top line will see some slight deceleration next quarter. However, Azure revenue growth is expected to be 37%, which is a continued acceleration from the 34% it generated this quarter. So that is how the outlook for the next quarter is projected to be, and it is wild that Azure is projected to continue accelerating from here. Moving on to the next screenshot, this one comes from the transcript where Satya Nadella said, "We opened new data centers across 6 continents, now totaling over 400 across 70 regions. Microsoft has stood up more than 2 gigawatts of new capacity in the last 12 months and is scaling its own data center capacity faster than competitors." Azure surpassed $75 billion in annual revenue, up 34%. The company took share every quarter this year in the AI infrastructure wave. Demand for data center capacity remains higher than supply and is expected to continue through the first half of the fiscal year. So what Satya Nadella was saying on the earnings call is that Azure is winning in cloud. They're taking market share from Google Cloud and Amazon Web Services. And the growth rates to Azure are actually higher than Google Cloud reported and also AWS, as we're going to see. And what is impressive about this is Azure is larger than Google Cloud. So it's working off of a larger base and it's now growing even faster. So Microsoft Azure is absolutely killing it, and they're clearly winning this AI cloud wave, and they're taking market share, which is really good to see for Microsoft and its shareholders. Now, moving on to the next screenshot, this once again is just Satya saying that demand remains higher than supply. So there's probably going to be this continued acceleration and strong cloud growth for the next at least 6 months. So let's head back over to Stock Unlock and take a look at Microsoft's KPIs here. So here we can see their long-term revenue chart, and we can clearly see that revenue is at an all-time high and momentum is still there. Microsoft's revenue growth is nothing short of incredible. Microsoft's operating income also continues to hit fresh all-time highs with a very strong quarter. Net income also hit a fresh all-time high of that $101.83 billion in trailing 12 months net income now. Now let's take a look at operating cash flows, and operating cash flows are at an all-time high of $136.2 billion now, and the growth here is also very impressive. Now what's interesting is if we take a look at free cash flows are not growing at the same rate as operating cash flows. And this is simply because Microsoft is spending so much money on capital expenditures, which is suppressing their free cash flows. In fact, free cash flows have not really grown now since about 2022. And this is why I think it makes the most sense to focus on these businesses' operating cash flows right now, simply because their capital expenditures are absolutely skyrocketing, which is suppressing free cash flows. And I think that operating cash flows gives us a better indicator as to how much profits these businesses could potentially be producing and how much profits their operations are actually producing. So with that being said, let's go over to Stock Unlock's Freeform tool, and let's take a look at Microsoft's price to operating cash flow now. And here we can see that Microsoft's price to operating cash flow is now sitting at around 29, which is on the high end of where the stock has historically traded. The highest it ever got was here at 31.4 in December of 2021, and that was right before the market correction that we saw in 2022, where Microsoft's price to operating cash flow got all the way back down to 19. So I don't necessarily think that Microsoft's stock is looking cheap today. I personally think that it is selling above fair value right now, and I'm not really interested in buying this stock here. So personally, I am not a buyer here, but overall, this was a fantastic quarter for Microsoft. They're clearly winning the AI and cloud revolution. They are taking market share. They're seeing the highest growth rates. Their margins were expanding. Revenue growth is accelerating. Azure revenue is accelerating. And overall, this was a blowout quarter for Microsoft. So again, I do think the stock does deserve to be trading for all-time highs, but in terms of if I'm buying the stock here, I am not a buyer up here, and I do think the stock is looking expensive in my opinion. All right, now let's move on to Meta's earnings. And in my opinion, Meta had the most impressive earnings results of the entire earnings season so far. And here we can see that Meta stock popped roughly 12% after their earnings report. It has sold off a little bit now with the overall market and the weakness that we have been seeing, but the reaction to Meta's earnings was incredibly strong. And the stock did pop to fresh all-time highs. So let's go through Meta's earnings results now, and I want to show you the highlights that I found. So here we can see that Meta's revenue grew 22% year over year to $47.5 billion. Income from operations grew by 38% to $20.4 billion, and earnings per share also grew by 38% to $7.14. So 22% top line growth and 38% earnings growth. This is incredible from Meta. And at one point I owned Meta stock, and unfortunately I did sell it way too freaking early, but I had no expectations that this company would see such an acceleration to its business on both the top line and the bottom line. It is blowing me away how consistent this company just continues to kill it, and Mark Zuckerberg did a phenomenal job turning this business around. But let's continue on. Here we can see that the family daily active people was 3.48 billion on average for June 2025, which is an increase of 6% year over year. So Meta has basically half of the world's population already using their platform, and somehow they're still growing their daily active people by 6%. That doesn't even make sense. The number of ad impressions across the family of apps also increased by 11% year over year, and the average price per ad increased by 9% year over year. So Meta has a double whammy of growth right now. They're showing more ads to more people, and the price per ad is also increasing. And that is causing a surge in the company's top line revenue. So now let's move on to the CFO outlook, where they said, we expect third quarter 2025 total revenue to be in the range of 47.5 to 50.5 billion. While we are not providing an outlook for fourth quarter revenue, we would expect our year-over-year growth rate in the fourth quarter of 2025 to be slower than the third quarter, as we lap a period of stronger growth in the fourth quarter of 2024. So Meta is expecting its next quarter year-over-year revenue growth to be about 18%, and they are expecting the fourth quarter to be lower than that, which does mean that Meta is expecting a revenue deceleration for the remainder of the year. But 18% growth in the next quarter is still very strong, and then who knows, we may see 15% growth in the fourth quarter of 2025. But moving on, they say, we expect full year 2025 total expenses to be in the range of 114 to 118 billion, narrowed from our prior outlook of 113 to 118 billion, and reflecting a growth rate of 20 to 24% year over year. So Meta is expecting their expenses this year to outpace the revenue growth, so their margins are probably going to be contracted in the second half of the year as well. Continuing on, while we are still very early in planning for next year, there are a few factors we expect will provide meaningful upward pressure on our 2026 total expense growth rate. The largest single driver of growth will be infrastructure costs, driven by a sharp acceleration in depreciation expense growth and higher operating costs, as we continue to scale up our infrastructure fleet. Aside from infrastructure, we expect the second largest driver of growth to be employee compensation, as we add technical talent in priority areas and recognize a full year of compensation expense for employees hired throughout 2025. We expect these factors will result in a 2026 year-over-year expense growth rate that is above the 2025 expense growth rate. So Meta is warning its investors that in 2026, expenses are going to accelerate even faster. And in 2025, Meta just told us that they're expecting their expense growth rate to be about 22%. So we should probably expect Meta's expense growth rates to be above 25%, maybe in the 30% range for 2026. And I do think that this will put pressure on their margins for next year. I don't necessarily know if the market is pricing this in or not, but basically the setup that we're seeing into the later half of this year is revenue deceleration, cost to increase, and that may continue into 2026. So that is something that I think investors should consider. Then the last paragraph for the outlook says, we currently expect 2025 capital expenditures, including principal payments on finance leases, to be in the range of $66 to $72 billion, narrowed from our prior outlook of $64 to $72 billion. And up approximately $30 billion year over year. So Meta is also spending a lot more money on capital expenditures this year. So now let's move on to Meta's cash flow statement, and this is very impressive. So here we can see their operating cash flows came in at 25.6 billion, which is up roughly 32% year over year. Year to date, Meta has produced $49.6 billion in operating cash flow, which is up 28% year over year. So Meta's operating cash flows are growing extremely quickly, faster than revenue, so their operating cash flow margin is expanding, and this is a fantastic growth rate to the business. Now, if we take a look at purchases of property, plant, and equipment, which is capital expenditures, they did more than double year over year for this quarter to 16.5 billion. And year to date, Meta has spent $29.5 billion on CapEx, which is almost a double as well. So they're spending a lot more money on CapEx, just like every other cloud hyperscaler and AI company right now. Lastly, let's take a look at their share repurchases. And in the quarter, they did $10.2 billion of buybacks, and year to date, they have done $23 billion worth of buybacks. Now, what's interesting is Meta only produced about $9 billion in free cash flow this quarter, so they spent more money on buybacks than they produced in free cash flow. And that is the exact same story with the year to date numbers as well. So Meta is spending more on buybacks than the company is producing in free cash flow right now, which means that they are dipping into their cash position to buy back shares. And this is exactly what we are seeing on the balance sheet. Here we can see that Meta's cash and cash equivalents have dropped to $12 billion versus about $44 billion at the start of the year. So they have spent a net of about $31 billion in cash, mostly on buybacks and dividends now. So they are dipping into their cash position to buy back shares. And I've seen a lot of people online saying that this is a red flag, they're spending way too much cash on buying back shares. And my opinion is slightly different because I think Meta has the cash on the balance sheet to go and buy back shares. They're still free cash flow positive, so there's still cash coming into the business, even with their increased capital expenditures. So the only thing that I think investors need to know here is that Meta's rate of buying back shares is unsustainable right now while they're going through their massive CapEx cycle. So I don't think that investors should expect Meta to continue spending the current levels of cash that they are on buybacks going forward, because it's quite literally unsustainable and they don't have the cash to keep this up forever. So that's all I would say for investors, is just don't expect this level of buybacks to continue going forward. So now let's head over to Stock Unlock and take a look at some of Meta's KPIs here. And here we can see that their revenue is clearly growing and hitting a fresh all-time high of $179 billion in the trailing 12 months now. And if we zoom out more, we can clearly see that Meta did go through that weak period in 2022 and in 2023 when people were saying that the business was dead and it was trading for 9 times free cash flows. And we can see that Mark Zuckerberg has successfully turned around this business and it's growing extremely well once again. So hats off to Meta. This is incredible. Meta's operating cash flows are also continuing to grow extremely well, and they're hitting an all-time high of $102.3 billion now. However, just like with Microsoft, if we go and take a look at Meta's free cash flows, we can see that they have actually been coming down over the past few quarters, and they've produced about $50 billion in trailing 12 months free cash flow now. This is simply because how much money Meta is spending on capital expenditures. As we saw, their CapEx doubled year over year, and that is suppressing their free cash flows quite a bit. So let's head over to Stock Unlock's Freeform tool, and let's look at Meta's historical price to operating cash flow and where the company is trading today. Meta's price to operating cash flow after this report is now sitting at 18.4, and its long-term average has been about 17.4, but that does also include when the stock was ridiculously cheap in 2022. So in my opinion, and this is going to be kind of surprising, but if Meta can continue to scale their business and grow by 10 to 15% over the long term, then I don't think the business is looking very expensive today. I would say that it's probably one of the cheaper stocks in the Magnificent Seven, because an 18 price to operating cash flows, while the business is growing its revenues by 18 to 20% year over year, is really not that expensive in my opinion. So if Meta is not looking expensive today, then the question is, why am I not a buyer? And I wrote down some notes here. So the first one is that I think investors should be aware, as I said earlier on in the video, that costs are expected to grow faster than revenue over the next about 18 months now. So I think that investors should be expecting some margin compression and maybe some headwinds to overall profits and earnings over the next year or so. As I also said earlier on in the video, I owned Meta at one point in the past, and at that time, I was not expecting Meta's business to accelerate growth and see 20% revenue growth. This kind of suggests to me that me trying to predict the future of Meta's business, or let me rephrase that. I can't predict the future of Meta's business. Therefore, I think that this one is out of my circle of competence, and I really don't know what the future of this business looks like because I was wrong on it massively, and I happen to be wrong on the upside. But that still kind of does suggest that it's a little bit out of my circle. And now we're going to get into the main reasons why I am not buying Meta, Microsoft, or even Amazon at these prices. And it's simply because I am finding a lot of value in the small and mid-cap international stock space right now. I am finding things that are trading for 12 times earnings, growing 20% plus consistently, with high insider ownership, long track records of growth, and I think that they have great business models. So to put it simply, I am finding things that I think offer much more upside potential outside of the mega cap US tech space. I think that every investor in the world wants to own US tech mega cap stocks right now. They want to be exposed to AI. And that's causing that sector to get kind of crowded. And in general, that's why you're getting Microsoft trading for all-time high price multiples, price to operating cash flows at 30, which I think is very high. So I think that it's just become kind of like a no-brainer that you need to own the Magnificent Seven or a subset of the Magnificent Seven. This has caused a lot of money to flow into the US markets, as I have talked about at length on my channel, and it's caused money to flow out of the international markets. And now I am finding extreme value for high quality companies in the international markets. And every time I talk about this, I do get some pushback, and it's a pretty controversial opinion of mine that investing in companies internationally can actually produce returns. But that's just what I feel most comfortable doing right now. It's where I'm finding the most value. I think that there are things selling for extremely cheap prices, and that's where I put more of my portfolio. And this is also the main reason why I am not interested in buying Microsoft, Meta, Google, Apple, and even Amazon at current prices. So that's what I am doing personally, and that's why I'm not buying all of these stocks. But in general, as I say down here, I think Meta is killing it, and I do not think that the stock looks overly expensive today. It really just comes down to risk reward and return potential. And I think that there's a lot more return potential in the international markets, and that's really what it comes down to for me. So with that being said, let's now move on to Amazon and talk about its earnings. And this is really going to be the meat of this video because this is, its earnings were kind of dramatic. The stock is now down 8% on the day at the time of recording this video. And the earnings were, they had some good and some bad. I would say it was not like a Meta or a Microsoft where the earnings were absolutely stellar. So let's just hop into the screenshots that I took here. So here we can see that Amazon's net sales increased by 13% to $167.7 billion in the quarter. That is a massive amount of revenue. North America segment sales increased by 11% to $100 billion. International segment sales increased by 16% to $36.8 billion. And the AWS segment sales increased by 17.5% to $30.9 billion. This AWS figure right here is one of the main reasons why the stock is selling off today. As we saw, Microsoft Azure grew by 34% year over year, and it is seeing its revenue growth accelerate. AWS is growing at half of the speed, and it is not seeing its revenue accelerate. Last quarter, they also saw 17% growth. So AWS is seemingly lagging behind both Google Cloud and Azure right now. I'm getting a little bit ahead of myself, but this is really the meat of the entire reason why the stock is down. And the first question that was asked on the earnings call, point blank, was like, why is AWS not accelerating with Azure and Google Cloud? Like, what's happening here? You guys are clearly losing market share. And in my opinion, Andy Jassy's response was kind of weak. Like, I was listening to the earnings call live, and after his answer to this question, you could visually see the stock dropped significantly in after hours. So investors were not happy with his response because his response was a very long way of saying, AWS is growing from a higher base, so it's more challenging to grow at higher rates, and the customer experience is what matters. That was his answer. So they're growing from a higher base, and the customer experience is what they focus on. Now, in my opinion, sure, the customer experience is important, but I also think that if your customer experience is truly the best, then you should be winning market share. Like, if you truly have the best product, then customers will be attracted to your product over competitors. But Amazon is losing market share in the cloud space. Now, to address his growing from a higher base comment there, obviously that's correct. That's the law of large numbers. When your base expands, it becomes much more challenging to maintain high growth rates. But Microsoft Azure is now at a $75 billion run rate. That's 65%-ish of AWS's size, and they're growing at double the rate. So I think that there is some validity to Amazon growth rates being lower, AWS growth rates being lower. But I think the fact that AWS growth rates are not accelerating with the other cloud providers is really the red flag there, because it is suggesting that Amazon's cloud offering is losing market share to both Microsoft and Google Cloud. Now, moving on, we can see that operating cash flows did increase by 12% to 121 billion for the trailing 12 months. Operating cash flows is the best metric to use when you're valuing Amazon or looking at Amazon's business. So this is great to see that operating cash flows are uptrending again, and they're at an all-time high of 121 billion. That's exactly what I want to see. Free cash flows declined to 18.2 billion. I literally could care less about this figure right now because they're going through a massive CapEx cycle. Now, moving on, this is their financial guide for the next quarter. And here they say that net sales are expected to be 174 to 180 billion, which is growth of 10 to 13%, which is pretty good. And operating income is expected to be between 15.5 billion and 20.5 billion, compared with 17.4 billion last year for the third quarter. So operating income is basically not projected to grow in the next quarter. And this was another sticking point for investors because this operating income guide was below what Wall Street was expecting. So Wall Street and investors thought that Amazon would post a higher operating income outlook. So this caused them to start selling off the stock as well. And I think that this was the reason why the stock immediately sold off after earnings. And then as the earnings call progressed, things honestly just kind of got worse. As I said, I'm an Amazon shareholder, but I do like to be objective, or try to be objective, and be critical of the businesses that I own. And in my opinion, that earnings call sucked. Andy Jassy did a bad job. It was not his best call. He's had much better calls historically. But the way he answered those questions, in my opinion, it just simply was not good. And you saw a very real response from the market when he was answering questions. And that's largely why Amazon is down so much. But moving on to the cash flow statement, we can see that operating cash flows grew to 32.5 billion in the second quarter of 2025. And if we just do some quick math here, 32.5 divided by 25. That is growth of 28% year over year. So this was a very strong quarter for operating cash flows, which is also good to see because in the first quarter, operating cash flows did decline slightly on a year over year basis. So it's good to see that they're growing again and growing strong, I may add. Year to date, operating cash flows are up by about 11% to 49.5 billion. And over the trailing 12 months, operating cash flows did grow by 12% to 121 billion, which is good to see. Now take a look at Amazon's capital expenditures, okay? They spent $32.2 billion on CapEx this quarter versus $17.6 billion last year. This is the most CapEx out of all of the mega cap hyperscalers. Amazon is plowing the most money into CapEx by far. In the first 6 months of the year, they spent 57.2 billion on CapEx, and in the trailing 12 months, it has been 108 billion. Now, on the conference call, they also said that this level of CapEx is what they expect to be spending for the remainder of the year on a go-forward basis. So if we go 32 billion in CapEx, multiply that by 4, that's about $128 billion of CapEx projected to be spent over the next year. That is an absurd amount of CapEx. But there's also something that's unique about Amazon's cash flow statement versus the other companies. And that's that Amazon does not pay a dividend and they are buying back 0 shares. There is not a penny spent on dividends or buybacks from Amazon. And in my opinion, this does give Amazon a little bit of a competitive advantage because it gives them more ability to spend a lot more money on CapEx. And Amazon is by far spending the most money on CapEx because they're not weighed down by a commitment to pay shareholders dividends. And they're simply just not interested in buying back stock when there is this massive CapEx opportunity to capture this AI revolution that's going on. And for me as an investor, this is what I want to see. When these companies are talking about spending so much money on CapEx, when they're saying they're supply constrained, they can't meet demand, for me, I'm like, why are you guys buying back shares then? Especially when your price multiples are high. Like, why not stop the buybacks? Ideally, even cut the dividend, but no one's going to cut their dividend because investors will react poorly. But why not also cut the dividend and just take that money and start spending it on CapEx so that you can actually start to meet all of your demand? That's what Amazon is doing. And that's why I resonate the most with this business, and partly why it's the only mega cap in my portfolio now. But let's continue on to the next screenshot now. And this one is specifically discussing AWS. We can see that AWS's net sales increased by 17%. However, their operating expenses increased almost directly in line with net sales, which means that AWS's operating income only grew by about $800 million year over year. The operating margin at AWS contracted significantly year over year and on a quarter over quarter basis. This was the main sticking point for a lot of investors on social media, was the profitability of AWS going down. Now, Andy Jassy has said that the operating margin of AWS will fluctuate over time. It's not going to be consistent. When they're investing, going through CapEx cycles, the margins of AWS will decline. That's just how it is. So I personally am not concerned by this, and I'm trying to focus on the long term. And long term, I do think that the margins will be fine. They'll continue to expand. And I don't think that investors should necessarily focus on the quarter to quarter results of a specific business segment and the margins of that specific business segment, because I think that the long-term picture here is just so much more important. Moving on to the next screenshot, this one shows the growth rates to all of Amazon's different business segments. We can see that online stores grew by 11% year over year. Third-party seller services also grew by 11%. Advertising services was the highlight for me this quarter, growing by 23% year over year. Subscription services grew by 12% and AWS grew by 17%. And this is something that I think investors also fail to remember on a quarterly basis, is that Amazon is a lot more than just AWS. I mean, look at this. Their third-party seller services is a $40 billion business that's still growing by double-digit growth rates. The advertising business is doing almost $16 billion in revenue per quarter, and it's growing by 23%. So I think that sometimes investors may get hung up a little bit too much on what happens to AWS from quarter to quarter. And when you zoom out and take a look at the overall bigger picture, Amazon's business is actually doing very well. And a point on Amazon advertising is that they actually had the strongest growth rates to revenue out of all of the advertising businesses. Meta's advertising business saw revenue growth of about 21%, and Google's advertising business only saw 10% revenue growth year over year. So Google was the big loser in terms of advertising revenue growth, and Amazon was the winner. Amazon is taking share in the overall advertising dollar spend market, and they're the third largest advertiser in the world now. So I thought that this was very impressive because Amazon is clearly attracting more advertisers to their advertising platforms, and they're taking more market share there. And conversely, I think that this is actually kind of bearish for Google, because Meta and Amazon both reported very strong advertising numbers, and Google is, the largest advertising company in the world, and their growth rates were significantly lower. They were more than half as low. Now, you could use the argument there that Google is growing from a larger base, so it's more challenging for them. And I do get that, but I still think that the growth to these other businesses was much more impressive than overall Google's growth. So let's continue on through the segment's information. And another highlight from the quarter is that the North American segment saw operating income grow by 48% year over year to $7.5 billion. Operating income in the trailing 12 months is also up 36% to $28.3 billion. So Amazon's North American business is seeing its operating income explode and its margins are expanding. I'm sorry that I'm itching my face, you guys. I'm getting my cat allergies again. All right, let's move on to the AWS segment, and we can see that net sales in the trailing 12 months are sitting at $116.4 billion now, and the operating margin dropped to 32.9% from 39.5% last quarter. And this was the lowest margin quarter since the first quarter of 2024. So the AWS margin really took a hit this quarter. Now, moving on to the next screenshot, this one comes from X from Altimeter. And I think that this is just a really good visual as to the growth rates of all of the different major cloud providers. So here we can see that AWS year-over-year growth rate was that 17%, and we can see that it's really not accelerating. And now take a look at Azure's year-over-year growth. It is absolutely accelerating. I don't think that the most recent quarter was 39%. It was actually about 34%. Maybe they're using some different number here, but you can clearly see that Azure's revenue growth is accelerating and in a big way, and Amazon's is not. Google Cloud is also seeing its revenue growth rates accelerate to 32%. But when we take a look here, it's very clear that Microsoft Azure is winning in cloud. They're taking market share, and they have the most impressive metrics right here. And this is why analysts on the conference call and so many investors are selling Amazon today, is simply because it's the clear outlier here of not very much revenue growth. Hey everyone, I'm just editing this video right now, and I realized that I completely missed my note on AWS having $195 billion worth of backlog now, which is up 25% year over year. This does kind of suggest that AWS is constrained because their backlog is growing a lot. So if AWS could have actually executed on this revenue and on this backlog, then revenue could have been quite a bit higher this quarter. So I do think that does kind of offset the negativity towards AWS's growth being a little bit slower this quarter, and its margins maybe being a little bit more suppressed as well, simply because the backlog is growing much, much faster than the overall revenue. So there is a large revenue growth opportunity there if AWS can simply build out their capacity and meet all of that demand. So let's move on to the transcript for Amazon now. And here Andy Jassy said, "We have more demand than we have capacity right now." So this means that all of the businesses, Google, Microsoft, and Amazon, all have said that there's still more demand than capacity. And this is why they're all ramping up their capital expenditures to try and meet the demand that they're seeing. Then he continued on and said, "So we could be doing more revenue and helping customers more. And we're working very hard on changing that outcome and how much capacity we have. But it's still like, if you look at the business, it's $123 billion in annual revenue run rate business, and it's still early. I mean, how often do you have an opportunity that's $123 billion of an annual revenue run rate where you say it's still early? It's a very unusual opportunity that we're very bullish about." So Andy Jassy is saying here that, AWS is a huge business, but it's still early days and this business has a long run rate ahead of it. Then he also said, "The single biggest constraint is power." Now, there's not a lot that I want to say about that other than, Brookfield is supplying the power or helping supply the power for all of these data centers. Literal energy is the bottleneck right now. These companies cannot build energy fast enough. So I think that this actually bodes well for Brookfield's business because they're one of the partners of choice for all Amazon, Microsoft, Meta, and Google. They're helping these companies build out their energy infrastructure so that they can power their data centers and power AI. In fact, Brookfield is now one of the largest data center builders in all of Europe, and they're signing deals that are worth tens of billions of dollars. So I thought that screenshot kind of just shows that Brookfield probably still has a long runway for continued growth as well. And that's the way that I am personally playing AI, because Brookfield is just, in my opinion, a very good business that I do believe is still undervalued as well. But getting back over to Amazon, I think that this was an okay quarter. I don't think that it was a blowout quarter. I'm not rushing out to buy more Amazon shares right now. And honestly, I'm not really interested in buying Amazon shares right now because I do think the business is selling for around fair value. And that's kind of just my opinion on Amazon. It is the one Magnificent Seven stock that I do own in my portfolio. And I still see the long-term opportunity here. I am not going to get shaken out based on one quarter or based on the stock falling 8%. Just zoom out a little bit, right? Take a look at a one-year chart. Amazon is at $215 right now. That is the same price that it was trading for back on June 10th. So, okay, we've lost a month of gains, right? This is not a big deal. It's really not a big deal. I see people freaking out. I think everyone's just got to relax, zoom out, think about the long term. And in general, yeah, I think Amazon is going to be just fine. Now, in terms of the price of this business today, as I said, I personally think that it is selling for around fair value. I do like to look at its price to operating cash flows, and it is trading for around 18 times operating cash flows right now. That is below the company's historical averages because its historical average price to operating cash flow has been about 25. But I think that this is kind of fair because Amazon's business, if you want to use Andy Jassy's terms, it's growing from a much larger base. So I don't think that Amazon is going to see massive and sustained, 20% operating cash flow growth rates from here. I think that they could achieve 12%. And based on my DCFs, if Amazon can achieve a 12% operating cash flow growth rate, then I think that the stock is probably fairly valued today. And due to its growth rates being lower, I don't think that it's going to trade for like 28 times operating cash flows like it did when it was a smaller business. So for those reasons, I do think that there is some warrant for Amazon to see some slight multiple compression. And I do think that its growth rates to operating cash flows will be around 12%. And with those assumptions, when I put it in my DCF, I get about fair value today. So for those reasons, I'm personally not buying Amazon. I'm also not selling it. I don't think there's any reason to sell it. And that's kind of my opinion on Amazon's results. They were okay. They weren't a blowout. They weren't terrible. There were some highlights there. AWS was definitely not a good thing, but the advertising business really did come out strong. It was the fastest growing advertising business out of Amazon, Meta, and Google. So there were some good things. North American segment also grew operating income very well. International sales are growing. International operating income is doing very well as well. So yeah, it was an okay quarter. Not a great one, but an okay quarter. And with all that being said, that is going to wrap up today's video. So I will be getting to more earnings results next week when I make my next week's video, and I'll be talking about a lot more companies then. I believe Mercado Libre reports on Monday, so I'll actually try and get a video out on Monday. So I'll see you all next week, and if you did enjoy the video, please remember to leave a like on it. And if you want to stick around and see more stock market related content like this, then please remember to subscribe to my channel. And if you want to see what I own in my portfolio, track my monthly progress, see my portfolio performance, and get so much more content from me, then you can check out my Patreon. My Patreon members have been absolutely loving it over there and getting a ton of value, and I think that you will too. My Patreon is only $15 per month, and I will leave a link in the description if you want to go and check it out. But again, with all that being said, I am going to wrap up the video, so thank you all so much for tuning in. As always, I truly do appreciate it, and I hope to see you again in my next one.